Hey everyone, welcome back. Charlie Bilello here. This is a special edition of the Week in Charts called Put These Charts on Your Wall. It's something I do every year, picking out charts that really tell an important lesson for investors. This is the 2023 edition, a lot to choose from this year. So put these charts on your wall for the next time you think it's at support or resistance and can't possibly go any lower or higher. A few examples from this year on the downside would be Pfizer constantly breaking through support. It was oversold very early in the year and continued to go lower and lower. We see this all the time in markets. Don't think just because it's at support or it's oversold that it can't go any lower. Flip side would be Nvidia, of course, overbought very early in the year at resistance, just blows through that resistance, continues to rise throughout the year, blowing through every resistance point, was overbought many times this year, and ended up being the top stock in the S&P 500 in 2023. It can't go any higher. This is something you hear all the time, whether it's stocks or whether it's economic statistics, any type of data point. People often say it can't go any higher or lower. A few examples this year. One would be credit card interest rates, 21%. It broke through all-time record high. And just a few years ago, looking at March 2022, 14.5%. So huge increase. A lot of people said, well, it can't go higher. 21% record high. 30-year mortgage rate, similar thing here. We hit an all-time low back in January 2021, 2.65%. Fast forward to this year, we saw rates hit their highest level since 2000, 7.79%. Stocks can't go up when the Fed tightens. And this is something we covered a lot this year, that notion, don't fight the Fed. And when the Fed is tightening policies, hiking interest rates, shrinking its balance sheet, it's said that stocks have to go down. And if we look where we are today, it's absolutely hasn't been the case that stocks have gone down since the Fed has started hiking rates. So back in March 16th, 2022, Fed first hiked interest rates. They proceeded to continue to hike interest rates all the way up to 5.25 to 5.5% this year. And where's the S&P 500 today? It's 9% higher than where it was in March 2022. So the stock market doesn't have to go down when the Fed is hiking rates. We hear this all the time, but if we look at the last few cycles, stock market's actually higher after the Fed has hiked interest rates, and that's true again this time around. If we look at the Fed's balance sheet, it's often said, well, when the Fed is doing quantitative easing, that's when you want to buy stocks. And when Fed is tightening policy, stocks have to fall. And while they did fall a little bit in 2022, they came back this year. And now the S&P 500 is 7% higher than when the Fed started shrinking its balance sheet back in April 2022. The Fed has shrunk that balance sheet 1.24 trillion over this period of time, and it didn't stop the market from being higher than when the assets hit their peak in April 2022. Home prices must go down when mortgage rates rise is a big one that people have been saying over the past few years. And we had that all-time low in interest rates back in January 2021, 2.65% 30-year mortgage rate in the US. Fast forward to this year, went as high as 7.79% using Freddie Mac data. What did the National Home Price Index do over this period of time? Not only did it not go down, it actually went up 32% since the mortgage rate low here in January 2021. So certainly interest rates are a factor, but definitely not the only factor in determining home prices. That was a big shock this year with home prices continuing to go up, even though mortgage rates were at their highest levels in decades. Bear markets are always a sign of recession. You hear this all the time when the stock market's going down and going down big, 20% or more. We hear people say, well, this has to be a sign of a recession. The stock market is the economy, people often say. But the truth is, not always is a stock market decline an indication that the economy is in a downturn. We saw that again. Now, in hindsight, we know the 2022 decline was not associated with recession. Here we are at the end of 2023, still no recession. And we had that 28% decline in 2022. So that just adds to the list here of bear markets. We had one in 2018, 2011, 1998, 1987, and even more before that, of bear markets that weren't associated with a recession. So definitely not true that the stock market being down by itself can tell you that the economy is in a recession. And this is just the latest example of that. You can time a bear market bottom. This is a very tempting one for people because if you can get out of the stock market and stocks then go down and you get back in at a lower price, well, that's a very appealing concept. The problem is that investment returns aren't linear, and the stock market doesn't, when it bottoms, doesn't tend to move up gradually. So there isn't often a lot of time for you to get back in at that lower price, assuming you were able to get out at a higher price. And we saw this yet again over the past year. Stocks bottomed in October 2022. A year later, S&P 500 on a total return basis, 23.7% higher. And that follows the script. If we look at 2020, 2009, even bigger gains off of the lows. You don't tend to see a gradual increase off of a bear market low. You tend to see an explosion higher. The average one-year gain, of course, for the S&P 500 is around 10%. You can see the average off of these bear market lows, 45%. So an important lesson for investors: timing a market's very difficult by itself, but this fact makes it even more difficult that oftentimes the market moves in a vertical fashion off of a low. Volatility will never be low again. If we go back a few years, the VIX hit a record closing high in March 2020. A lot of people were saying it's never going to come down again. We'll never see a period of calm and low volatility. Well, here we are, 2023, just a few years later. We have the lowest close for the VIX since November 2019, 12 VIX. Unbelievable to see volatility coming back down, but it shouldn't be that surprising for investors because this is one of the most mean reverting things that we see in markets. Extreme high volatility has always come down in the past, and extreme low volatility has always gone up. It's just the nature of markets, and it can do it much faster than you think. When the world seems like it's coming to an end and volatility will never be low again, well, that's simply not the case. Just give it time and the markets will calm themselves. So investment returns are linear and markets tend to follow a normal distribution. Hugely important for investors to understand this is absolutely not the case. Investment returns are very much not linear. You don't see a steady advance higher over a year, even though the market does 10% a year. It definitely doesn't do that every year. And we don't see that 10% evenly distributed throughout the year in terms of X% per month. And if we look at the recent performance of stocks and bonds, 60-40 really tells that story. And then some. US aggregate bond index, so this is a total bond market index, over 40 trading days from October through December, up 8.7%. That's the best 40-day return we've seen in decades. So we're talking about a few years worth of returns for bonds truncated in this 40 trading day period. We see that all the time in markets. And then in terms of the so-called normal distribution, we'll throw that out the window. The markets definitely don't follow it. We have examples every single year of these multi-standard deviation events that are supposed to be impossible if the markets followed a normal distribution, but the market doesn't. So if we look at this 12 sigma event in the 1 to 3 year treasury bond ETF, statistically, this should never have happened once, even in the history of the universe. But every single year we see something like this happen. So investors piled into this ETF during the period of bank failures, and we saw interest rates collapse. And it's an extreme move in markets. And every single year we see this with a different asset class, different security, showing that the markets don't follow a normal distribution. There are fat tails where unlikely events happen much more frequently than you would predict if markets were following a normal distribution. Big bank failures must lead to another financial crisis. This is extremely important for investors to understand that there's going to be bad news in a given year. We don't know what that news is going to be, but this year we had the second, third, and fourth largest bank failures in history, looking at the size of assets at the time of failure. And this was a huge one. If you go back to March, you look at the headlines. A lot of people were saying this is going to be the next 2008. How could you have these huge bank failures without a financial crisis? Well, we didn't have it. Obviously, FDIC came in. A lot of things were done to shore up confidence. The Fed provided a backstop for a lot of these banks in terms of short term lending of securities. And it didn't end up leading to a financial crisis this time around. So it's instructive to say every time is different. Just because something happened in the past doesn't mean it will happen in the future. The big can't get any bigger and the small can't get any smaller. This is a huge concept over the past few years, particularly this year where we saw a resurgence in the largest stocks. Obviously, you've heard of the Magnificent Seven. Here I'm broadening it to the top 10 holdings in the S&P 500, which hit their largest concentration ever, 30.5%. Data going back to 1980. We've never seen the S&P 500 more concentrated in just 10 stocks than we're seeing in 2023. And if we zoom into the top two annual holdings here, Apple and Microsoft, 14.7%, highest on record for any two holdings in the index. And the flip side of this is smaller companies as a share of the overall market has been going down. And this can be seen in looking at a ratio of the small cap index, Russell 2000 to the S&P 500, hitting its lowest levels this year since December 2000. And so we see these huge relationships in markets going on much longer than people think. They say, well, how can small caps underperform any longer? And they just continue to underperform. Of course, at some point, this will turn around. Maybe next year will be the year for small caps, international. And if we look at value and growth, similar story there. These trends can go on much longer than you think. So what happened last year is a good indication of what will happen next year. Obviously, it's tempting to feel that way. If we look at 2022, stocks were down a lot. We had big tech stocks down more than the market. It was tempting to believe that would continue in 2023. And what we actually saw was actually the polar opposite in terms of performance in 2022. All of these big tech stocks, I call them the enormous eight: Nvidia, Meta, Tesla, Amazon, Netflix, Google, Microsoft, and Apple, all down big in 2022. And this year, all up enormous, 50% or more for all of these stocks. We saw the same for the major indices, looking at the S&P, NASDAQ 100, down big in 2022, up big this year. Cars are an appreciating asset class. This is probably something that sounds ridiculous, but people are actually saying that back in 2022 when we saw used car prices and new car prices just exploding higher. And people were actually, for a brief period of time, flipping Teslas and flipping cars like houses because if you bought that car a month later, 2 months later, the car was worth more. We could see that in the average price of a used Tesla here. And what happened is what happened is back to reality. The fact that cars are very much not an appreciating asset unless it's a collectible car. The value tends to go down with use over time. And we see here now the average price of a used Tesla, $30,000 lower than that peak when people were saying cars are an appreciating asset and you can flip car. So 30,000, over 40% decline since that peak in 2022. Past performance is indicative of future results. No, we've seen this disclaimer. You're not supposed to believe that, but we oftentimes believe that just because something's outperformed a lot in the past, it means it's going to outperform a lot in the future. That's why we see money chasing funds that have done well in the past or stocks that have done well in the past. That's why there's such a thing as momentum. But oftentimes, past performance is not indicative of future results at all. And Silicon Valley Bank, I think, tells the story. It had huge outperformance by the end of 2021 versus the S&P 500. Probably surprising for people to see this. It outperformed the S&P 500 by an enormous amount over the previous decade. And then since then, you can see huge underperformance to the point where Silicon Valley obviously files for bankruptcy. And the lesson here is that don't get comfortable thinking if you're in a stock that's outperformed by a huge amount over the last decade, don't think that by itself is an indication that it's going to continue over the next decade. Picking stocks is easy. Just buy what you know. This is an old saying attributed to Peter Lynch, but the truth is the way he picked stocks was much more complicated than just buying what he knew. But people often say that buy what you know. If you go to a store and you use the product, well, that should be something that you should be buying. And that's an easy way to outperform the index. Not very easy. It's definitely not as simple as that whatsoever. Disney, I think, being a perfect example. A lot of people, of course, have watched their movies, gone to Disney World, used their products, and we see Disney for a long period of time did well versus the market. Recently, not so much. Last 8 years, Disney stock is actually down while the S&P 500 is up 150%. So a lot can change in a short period of time. And just because you think a brand can't be tarnished, brand can't go down in value, well, that's exactly what has happened with Disney and many other examples throughout history as well. A high valuation is a sufficient reason to short a stock. This is a dangerous concept for people to understand, that just because a stock has a high valuation doesn't mean that alone is going to bring it down. Certainly not in the short run, and you can be overrun with that stock going higher while its multiple expands even more, or earnings grows at a rapid fashion. I think this year the best example of that would definitely be NVIDIA. Came into the year with a P ratio of 62 times, so definitely on the higher end of the valuation spectrum. And what did NVIDIA do this year? It more than triples, goes up 234%, best performing stock in the S&P 500 this year. Where's its P ratio today? Well, it's still around the same level, and that's because its earnings exploded higher this year and are expected to continue to go up in the next few quarters. So it doesn't mean that a high valuation stock is immune to going down. It's just using that as a timing indicator to tell you this is a good time to short it because its valuation is high. That by itself definitely isn't sufficient. And you can see the stock continue to move higher despite this high valuation. Investors are rational and follow the adage buy low, sell high. So investors learn this, if nothing else, in this video. Investors are definitely not rational. They definitely, in mass, don't buy low and sell high. They definitely do the exact opposite. This is not something you should be doing, of course, but most people are human beings. They're emotional. We're emotional animals. And if we look at this sentiment poll, AAII, it does this percentage of bulls, bears every week. And what we saw in December 2022 was 32% more bears than bulls. So extreme negative sentiment. You had a lot of pessimism. The stock market obviously down. People were talking about a recession. And what actually happened, of course, was no recession. The stock market did well over the next year. And what happened to sentiment over that period of time? Well, it got much more bullish. If we fast forward to today, we have 32% more bulls than bears in that same poll. And why is it that investors are more optimistic today? Well, the S&P 500 is 25% higher. So investors are definitely not rational. If they were rational, they would be more bullish when stocks are lower, less bullish when stocks are higher. But they don't do that. And we see that time and again. Investors like it when stocks go up in a rapid fashion. They hate it when stocks go down in a rapid fashion. That's the exact opposite of how you should be behaving if you're a long-term investor. The streak can't go on for any longer. We hear this all the time. We see a lot of streaks in markets, whether it's number of up days or down days in a row. And you often hear people say, well, it can't go on any longer. This is a really interesting one here. You have the Dow Jones Industrial Average looking at the number of all-time highs every year going back to 1900. And lo and behold, we hit another all-time high for the Dow this year. It didn't seem likely coming into the year, but we actually hit it. And we've now got 5 so far in 2023. And that makes it now 11 straight years where the Dow has hit at least one all-time high. And that is one shy of the record that was set from 1989 to 2000, where the Dow went 12 straight years with at least one all-time high. So in 2024, if we hit one more all-time high, it's going to be tying the record there. And who's to say that can't go on for 13 years or 14 years? No one can say that because the market is constantly doing things that it hasn't done before. Profits don't matter anymore. This is something that sounds ridiculous, but if you go back a few years, a lot of people were saying it during the media in 2021. And WeWork, I think, would be a good example here. Went public. It was amazing that it went public at the valuation it did, because it had just a history of losing money. But a lot of people said about WeWork and many other companies similar to WeWork, don't worry about it. Profits don't matter anymore. All that matters is top line growth. And fast forward to today, profits very much did matter. WeWork filed for bankruptcy in November, and all of that market cap has now been erased. And total losses for WeWork since January 2016, $17 billion. So in the end, profits did matter. Maybe in the short run, they don't matter. But in the long run, the market is a weighing machine, and eventually you have to make money to survive as a public company. The workers are never coming back. This was something that we heard during COVID when the jobs just collapsed. People left the labor force, and we had just a collapse in the labor force participation rate, even for prime age workers, 25 to 54. And great news this year, we saw the labor force participation rate among prime age workers hit its highest level since May 2002. So the workers are very much coming back. We've had now a streak of jobs growth in the US now gone on for a few years. That's great to see. Hopefully that continues in 2024. And if we look at the unemployment rate in the US, it actually hit its lowest levels this year, 3.4% since 1969. So incredible to see. We went from 14.7%, which is the highest unemployment rate since the Great Depression, down to the lowest rate since 1969 in just a few short years. Definitely no one was predicting that back in March and April of 2020. Bonds are risk-free, and you heard that a lot pre-2020. If you fast forward today, probably no one is really saying that anymore. Hopefully they learned the lesson that bonds very much have risk, especially long duration bonds that are sensitive to interest rates. And this would be the most extreme example here, the 25 plus zero coupon ETF, the zeros ETF. And it went down 66% from its peak in March 2020 to the low in October of this year. And why did it go down so much? Well, because interest rates rose from 0.8%, the all-time low on the 30-year Treasury yield, all the way up above 5% this year. And this is extremely sensitive to interest rates. So when interest rates are going down, that's great news for this ETF. Did very well in 2019, 2020, early 2020. But the reverse is also true. And when interest rates are rising from historic lows, there's no cushion in terms of that bond. And it's all just price declines. And that's what we saw here. And the incredible thing is that 66% decline is actually bigger than any S&P 500 decline. You have to go back all the way to the Great Depression to find a bigger decline in the stock market. So this bond ETF was actually riskier than the stock market's been since the Great Depression. Important lesson for investors to learn is know what you own and why you own it. So understand that just because it's a bond doesn't mean it can't go down a lot in value, even if it's a treasury bond ETF like the zeros was. Buying a stock based on a meme is a good idea. Probably not many people saying this today, but back in 2021, a lot of traders were saying this, and they were saying it because it seemed to be working. A meme would come out on Reddit, and the stock would explode higher and continue higher, and thousands of percent return in a short period of time. We saw a number of examples, GameStop, obviously, AMC, the other big one, which is what I'm showing you here. And from its peak in 2021, now 99% decline, hit an all-time low this year. So all of the gains were given back and more. And the lesson here for investors is ultimately a stock will trade based on its fundamentals. Ultimately, the weighing machine wins out. And the stock AMC was losing money back in 2021 when this all began. It's still losing money today. The only difference was herd behavior, crowding, sentiment, but none of that is sustainable. Ultimately, a company has to make money in order to sustain the type of price increases that we saw in AMC and other meme stocks. Next one here, supply demand imbalances will last forever. And I think the best example of this in 2023 would be egg prices. We had just had an absolute surge higher in egg prices early this year. We had the bird flu constricting the supply of chickens. That led to some shortage of eggs, egg prices went up, and a lot of people were saying, well, this is going to continue. We're going to see $10 for a dozen eggs, and so on and so on. But eventually, that didn't happen. Supply came back, prices came down, and it's an important lesson for people that if you let free market forces play out, eventually that supply demand equation will right itself, and that definitely was the case with the price of eggs. Making changes to your portfolio based on headlines is a good idea. Obviously, that's very much not a good idea, but it's easy to look at a headline and say, I should act based on this, especially if it's an extreme headline. We saw a lot of headlines talking about the death of 60/40 at the end of October. You had the bond market in its worst bear market in history. You had stocks in a correction at the time. And people were saying, look at this headline here, we're not in Kansas anymore. Why the 60/40 portfolio might be dead and what to do now. What investors should have done then is absolutely nothing. If anything, they should have doubled down on this portfolio. And we see here the return for the stock market up 16%, bond market up 9%, one of the biggest short-term runs in history. And every year we see fear-inducing headlines like this that encourages investors to act. And oftentimes they should be doing the exact opposite of what the headline is suggesting. So rising national debt must be bad for the stock market. We hear this all the time, and you could substitute national debt for just about any type of bad economic statistic that you hear. And people will say, because national debt is going up, the stock market should be going down. Well, that's obviously not the case. If you look at this chart, look at the Dow and US national debt, both going up over time. And that's not to say that national debt isn't a problem today. I've been making the case that it is a problem. We need to shrink the deficit. We don't want this to become a crisis for the nation. But the stock market is not the same as the US government. The stock market's ultimately a reflection of profits. And unless those profits are impaired by increasing national debt, the stock market over a long period of time should be higher. Now, US corporations are not running the same type of system that the government is running, which is to say, they're not continually spending more money than they take in. US corporations are very profitable. They're trying to become more profitable, opposite of what the government does. So we shouldn't expect there to be a tight relationship between these two variables, because the behavior of the government and US companies, US businesses is very much different. So will the national debt be higher in 2024? I think almost certainly yes. Will that hurt the stock market? Probably not. And it would take something really catastrophic in terms of the debt, and hopefully we don't get there, for it to have a meaningful impact in terms, long-term impact in terms of the stock market. Big returns come without big drawdowns. Huge lesson for investors to understand that if you want to have big returns in the long run, assuming you can buy a stock that is going to outperform the market and go up a lot, but you have to be willing to withstand enormous drawdowns along the way. NVIDIA being the most talked about stock today, and for good reason, just ridiculous returns since its IPO in 1999, 64,000%. But that did not come about without a number of periods of extreme pain, 90+% drawdowns, and the notion that NVIDIA won't have a drawdown of 40, 50%. Again, it's a foolish notion. If you're buying NVIDIA today, fully expect it to have another huge drawdown in the future. That's true of any big winner throughout history. Central planning is a better system than free market capitalism. It's obviously not the case, but a lot of people were saying that a decade ago when China was stronger, growth was doing well, its stock market was doing well. A lot of people now on the other side of the camp saying capitalism is indeed better. And I think this chart illustrates this. S&P 500, 213% gain over the last 10 years. China large cap ETF is down 21%. So this notion that a few people should be deciding everything for an economy and that could be good in the long run, I think that's a unbelievably foolish notion. If we look at the profitability of Chinese companies versus US companies, night and day over the last decade. So this is a chart very much reflecting that fact that capitalism in the long run is a much better system than central planning. Wall Street experts can predict the future. Definitely cannot predict the future. Don't rely on Wall Street experts. And when they have this consensus belief that something is going to happen, oftentimes the exact opposite happens. This was definitely true in 2023. For the first time in decades, strategists were saying there was going to be a down year in stocks for the S&P 500. Where we are today, 24% gain for the S&P 500. And time and again, these strategists get it wrong, and they get it wrong because they're human. Nobody can predict what's going to happen in the future, and you certainly can't predict where the S&P 500 is going to be 12 months from now, because there's so many factors that go into that. It's not just earnings, it's not just sentiment, it's a million different factors that are influencing where the stock market's going to go over the next 12 months. So don't rely on that. Focus on your own plan, your own allocation. Think longer term. Don't worry necessarily what's going to happen in the next year. If the stock market goes down, well, that's an opportunity to buy more. If the stock market goes up, well, that's normally what it does. So throw out any and all predictions from these strategists. Use it just as entertainment, not as something actionable. If people ask me for one chart that would illustrate why you need to invest, it would be this one. And the notion that putting money under your mattress is an effective strategy to combat inflation is a ridiculous notion. And over the last 30 years, we have the value of the US dollar being cut in half and more. So down over 50% your purchasing power if you just put your money under your mattress or leave it in a checking account. And what has the stock market done over that period of time? It's exceeded inflation by 764%. So over the long run, and this in any given year, this might not be true, but over 20-year, 30-year, 40-year periods, it's been true that being an investor has been not only the best way to preserve your wealth, but to enhance your wealth and exceed inflation. And that amount may vary. It's been a very good last decade in terms of stocks versus inflation. Might very well be less over the next decade. But if you're looking out 20, 30 years, you want to protect yourself from rising prices. There's going to be inflation. We just don't know how much. Being an investor is the best way to do that. So they say a picture is worth 1,000 words. And when it comes to markets, that's absolutely true. You want to find extreme examples like we've gone through today and put them on your wall. And you want to do that because they will help to remind you that there's no such thing as can't, won't, or has to when it comes to markets. The markets don't have to do anything, least of all what you think they should be doing. The market does what it wants, when it wants to, and is ultimately the real-time personification of collective human psychology with fear and greed on full display. And that's what makes it so hard to figure out. And that's what also makes it so interesting. Now, as an investor, there are going to be times where you should be skeptical, but there are other times where you have to suspend disbelief. Unfortunately, there's no manual to help you decipher which situation applies. So find some charts that speak to you personally and put them on your wall as a constant reminder that the range of possible outcomes is much wider than any of us think, for there is no impossible in markets.